Stellantis just made a massive move that could change the way you buy cars forever. We're talking about a game-changing price cut, up to 35% off on new Dodge, Ram, and Jeep models. Imagine walking into a dealership and seeing a brand new Ram 1500 for tens of thousands of dollars less than just a year ago. Sounds great, right? But here's the kicker. This could force Ford, General Motors, and even Tesla to slash their prices too. So what's really going on here? Is this the beginning of a pricing war that will make cars affordable again? Or is Stellantis making a desperate mistake that could backfire on the entire auto industry? Stick with us, because this story is far bigger than just one car company. What's happening? A 35% price cut on new vehicles is unheard of in the auto industry. Yet Stellantis, the parent company of Ram, Dodge, Chrysler, and Jeep, just made the biggest pricing move in recent memory. This is not a seasonal promotion or a short-term clearance sale. This is a long-term strategy that could change how cars and trucks are priced for years to come. For context, let's take a look at how this affects Stellantis' lineup. A Ram 1500 Tungsten, previously priced at over $100,000, will now start around $65,000. A Jeep Grand Cherokee that once felt overpriced at $70,000 could now be under $45,000. Even Dodge muscle cars, known for their high price tags, will see significant reductions. These new lower prices put Stellantis models in direct competition with brands that traditionally dominated their segments, such as Ford, General Motors, Toyota, and Honda. A Ram 1500 will now cost significantly less than a Ford F-150 or Chevrolet Silverado, forcing competitors to rethink their pricing strategies. So why now? Stellantis has long struggled with consumer perception that their vehicles are too expensive. With this massive price drop, they are making a statement, one that could either revitalize their sales or create even bigger financial problems. To understand why Stellantis is making such a drastic move, we need to look at how their pricing strategy got them into trouble in the first place. Stellantis' pricing crisis. How did we get here? For years, Stellantis positioned its brands as premium offerings, gradually pushing its prices higher and higher. Ram trucks became luxury vehicles with leather-clad interiors, high-tech features, and price tags that rivaled European sports cars. Jeep, once known for rugged off-road capability at an affordable price, transformed into a high-end brand with SUVs costing as much as luxury sedans. The Ram 1500 Tungsten became a symbol of this pricing problem, a pickup truck with an MSRP surpassing $100,000. This put it out of reach for most working-class buyers and small business owners, the very customers who once relied on Ram trucks. Even Dodge, known for its muscle cars, started pricing itself out of the market. A high-performance Dodge Charger or Challenger Hellcat could cost well over $90,000, making them unattainable for the average buyer. As Stellantis continued raising prices, buyers looked elsewhere. Instead of paying for a fully loaded Ram or Jeep, customers turned to competitors like Ford, General Motors, and Toyota, which offered similar features at a more reasonable price. The result? Sales collapsed. Unsold inventory started piling up on dealership lots. Stellantis was forced to offer deep discounts just to clear stock. Buyers hesitated to commit, waiting for Stellantis to correct its pricing strategy. Now, Stellantis is reversing course in an effort to win back lost customers and compete more aggressively. But this drastic shift in pricing raises a major question. How can they afford this? A price cut of this scale means Stellantis is sacrificing billions in potential revenue. How will they make up for it? The profit problem? How can they afford this? Slashing prices by 35% means Stellantis is losing tens of thousands of dollars per vehicle. So where will they make up for these losses? One way Stellantis might compensate for the revenue loss is by cutting manufacturing costs. This could include streamlining production, reducing the number of trims and options available, and possibly switching to cheaper materials and components in some models. Suppliers may also be pressured into lowering costs on parts and raw materials, helping Stellantis maintain profitability despite lower vehicle prices. Another potential strategy is squeezing dealership profits. Stellantis could shift some of the financial burden onto dealerships, forcing them to accept slimmer margins. Traditionally, dealerships make a significant portion of their profits through markups on high-demand vehicles, but Stellantis may require them to sell at the new lower MSRP, limiting their ability to inflate prices. This could create tension between Stellantis and its dealer network, potentially leading to resistance. The third and riskiest possibility is that Stellantis is banking on higher sales volume to offset lower prices. The logic is simple: if they can sell hundreds of thousands more vehicles, the overall revenue loss per unit could be neutralized. However, this is a huge gamble. If sales fail to increase significantly, Stellantis could end up in a worse financial position than before. The success of this pricing shift hinges on one key factor: will enough buyers rush back to Stellantis showrooms to make up for the revenue loss? If this strategy doesn't work, Stellantis could find itself in serious trouble. Is this a calculated move or a desperate attempt to stay afloat? What's really driving this move? While Stellantis presents this as a strategic move to improve affordability, some industry analysts believe it is a sign of desperation. Rising interest rates have made car loans more expensive, discouraging buyers from financing new vehicles. When interest rates climb, consumers think twice before taking on long-term debt for big purchases like trucks and SUVs. Stellantis price cuts may be an attempt to counteract this trend by making monthly payments more manageable. At the same time, the used car market is collapsing. During the pandemic, used car prices skyrocketed due to supply chain shortages and production delays. Now, those prices are falling fast. If a buyer can get a low-mileage used Ram 1500 for $20,000 less than a new one, they might skip the dealership altogether. By reducing new car prices, Stellantis is trying to make their vehicles more competitive with used alternatives. Consumer spending is also weakening, with many buyers hesitating to commit to large purchases due to economic uncertainty. Inflation has squeezed household budgets, making big-ticket items harder to justify. Stellantis needed to act fast before losing even more market share to competitors like Ford, General Motors, and Toyota. The biggest concern, however, is that Stellantis might be losing its grip on the market. Ford and General Motors dominate the American truck segment, while Toyota and Honda continue to outpace Jeep and Chrysler in SUV and sedan sales. Stellantis had to make a bold move to stay competitive, if the stakes are incredibly high. If this pricing strategy fails to drive more sales, Stellantis could lose billions of dollars and find itself in financial turmoil. This raises another critical question: how will competitors like Ford, General Motors, and Toyota respond? Will they lower prices as well, or let Stellantis take the risk alone? Stellantis isn't the only player in the game. Ford, General Motors, and Toyota are watching closely, and their response could change the industry forever. Ford's dilemma: can the F-Series compete? For over 40 years, the Ford F-Series has been the best-selling truck in America. Ford built its reputation on reliability, performance, and strong brand loyalty. However, with Ram trucks now priced up to 35% lower, the question is, can the F-Series continue to dominate, or will customers switch to Ram for better deals? Ford faces a critical dilemma. Should they lower prices to compete with Stellantis, knowing that it will cut into their profits? Or should they hold their ground, relying on the strength of the Ford brand and the loyalty of their existing customers? If they choose the second option, they risk losing potential buyers to Stellantis, especially in the highly competitive full-size truck market. The impact on pricing is particularly striking. Previously, a fully loaded Ram 150 Tungsten was priced at over $100,000, putting it in luxury vehicle territory. Now, with Stellantis' new pricing model, that same truck costs around $65,000, directly competing with Ford's mid-tier trims. This means that even customers considering a Ford XLT or Lariat trim might now be tempted to switch to Ram for a higher-end truck at a much lower price. Ford's electric lineup is also at risk. The F-150 Lightning, already facing competition from Tesla's Cybertruck and Rivian's R1T, now has another problem: affordable Ram models offering premium features at traditional gas truck prices. If Ford cuts prices too aggressively, it might not be able to recover its investment in EV development, but if they keep prices high, buyers may look elsewhere. If Ford does not respond quickly, Stellantis could steal a significant portion of the truck market. The company's aggressive pricing strategy may force Ford into a corner, where they either slash prices to stay competitive or gamble that their reputation alone will keep buyers loyal. Either way, the F-Series is now facing one of its biggest challenges in decades. But Ford isn't the only one under pressure. General Motors has been struggling to keep up with Ford's truck dominance, and now Stellantis' aggressive pricing might push them even further behind. General Motors' reaction: will Silverado and Sierra prices drop? General Motors, which owns Chevrolet and GMC, now faces the same problem as Ford, except they are already losing ground in the truck market. The Chevrolet Silverado and GMC Sierra have consistently lagged behind the F-Series in sales, and now, with Stellantis undercutting them on price, they risk losing even more market share. The biggest issue for General Motors is that their trucks are already viewed as expensive. Many consumers have complained about rising Silverado and Sierra prices, particularly in the higher trims, where prices can reach $80,000 to $90,000. If Stellantis makes full-size trucks more affordable, customers who previously saw Silverado as a budget-friendly alternative to Ford and Ram may now switch to Ram instead. Another challenge is that General Motors is heavily invested in electric trucks. The Chevrolet Silverado EV and GMC Hummer EV have been marketed as premium electric trucks, with price tags starting well above $70,000. If Stellantis' price cuts force General Motors to lower traditional truck prices, it could disrupt their EV strategy and make it harder for them to convince customers to switch to electric. If General Motors does lower truck prices, it could have major financial consequences. Unlike Stellantis, they don't have an inventory crisis. Their problem has been declining consumer interest in expensive trucks. Cutting prices now might save sales volume in the short term, but it could also hurt profits and weaken their EV transition. The biggest risk for General Motors is falling into a reactionary position. If they wait too long, Stellantis and Ford may already dominate the market, leaving Chevrolet and GMC in a weaker competitive position. While the focus has been on trucks, Stellantis price cuts are also shaking up the SUV and sedan markets. How will Toyota and Honda respond? Toyota and Honda, will they be forced to cut prices? While Stellantis' price cuts mainly affect the truck segment, they are also putting huge pressure on Toyota and Honda in the SUV and sedan markets. For years, Toyota's Tacoma, Tundra, Highlander, and RAV4 have been top choices for consumers looking for reliability and resale value. Similarly, Honda's CR-V, Pilot, and Ridgeline have been strong sellers with consistent customer loyalty. But now, with Dodge and Jeep cutting prices, buyers might start reconsidering their options. One of the biggest threats is Toyota's SUV dominance. The Jeep Grand Cherokee and Dodge Durango, which were previously priced as premium models, are now directly competing with the Toyota Highlander and 4Runner. If Jeep and Dodge start offering higher-end SUVs at Toyota-like prices, Toyota may have no choice but to respond. Honda is in a similar position. The Honda Pilot has been a strong seller, but if a Dodge Durango offers a better feature set for less money, customers might rethink their brand loyalty. If Toyota and Honda refuse to lower prices, they could risk losing customers to Stellantis in key SUV segments. However, if they do lower prices, it might lead to a broader price war across the entire industry. But what if this pricing trend spreads beyond North America? Could Stellantis' bold strategy lead to global pricing shifts? The global impact. Could this go international? Stellantis' pricing strategy is currently focused on North America, but its effects could be felt worldwide. If Stellantis proves that aggressive price cuts boost sales, it could force global automakers to reconsider their pricing strategies. In Europe, automakers like Volkswagen, BMW, and Mercedes-Benz have already been raising prices steadily over the years. If Stellantis disrupts the North American market with more affordable trucks and SUVs, European brands may face pressure to offer more competitive pricing. At the same time, Chinese automakers are aggressively expanding into global markets. Brands like BYD, NIO, and Geely are already undercutting Western automakers in the electric vehicle segment. If Stellantis' pricing strategy forces American and European companies to cut prices, Chinese brands could use this opportunity to dominate the affordable EV space. If this price war spreads internationally, it could reshape the entire auto industry. Automakers might be forced to focus on affordability, increase efficiency, and reduce dealership markups. This shift could benefit consumers, but put massive pressure on manufacturers and dealerships worldwide. But there's one group that might not be celebrating these price cuts: dealerships. Could this move cause a total collapse of the traditional car sales model? The hidden consequences. Why this might be a disaster for dealerships. Stellantis' decision to slash manufacturers' suggested retail prices by 35% has shaken the auto industry, but not everyone is celebrating. While consumers may welcome the drastic price reduction, dealerships are facing a serious financial challenge. For years, car dealers have relied on markups, additional fees, and financing deals to boost their bottom line. However, Stellantis' move threatens this business model, forcing dealerships into a corner where profits profits could be squeezed to unsustainable levels. Beyond the dealership struggle, this price cut could also destabilize the used car market. If brand new Stellantis vehicles suddenly become significantly cheaper, the value of used Stellantis cars could plummet overnight. This could leave current owners underwater on their loans and impact the entire auto resale industry. Additionally, there is growing concern that Stellantis may cut costs elsewhere to offset the price reduction, potentially compromising the quality, durability, and reliability of their vehicles. But the biggest question remains: will Stellantis' strategy force the entire industry to follow suit, triggering a price war that resets the market? Let's dive into the unintended consequences of this pricing bombshell. The dealer backlash, why they hate this move. For dealerships, Stellantis' price cut is not a cause for celebration. It is a major problem. Unlike the automakers themselves, dealerships do not set manufacturers' suggested retail prices. They rely on markups, add-ons, and financing deals to make a profit. With Stellantis reducing sticker prices across the board, dealers will be left with less room to negotiate and lower profit margins on each vehicle sold. This could lead to several possible reactions from dealerships. Some may attempt to compensate for the lower manufacturer's suggested retail prices by adding hidden fees, service charges, protection packages, and dealership exclusive add-ons that inflate the final cost. Others might hold on to existing inventory longer, refusing to sell at the new lower prices to avoid taking financial losses. In extreme cases, some dealerships could refuse to carry Stellantis vehicles altogether if selling them becomes unprofitable. Another concern is dealer financing incentives. Many buyers depend on dealership financing to purchase a vehicle, and lower sticker prices mean smaller loan amounts. This translates to less interest earned by the dealership's finance department, another key revenue stream. If dealerships cannot make up the difference through other means, this pricing strategy could push some into financial distress. Ultimately, Stellantis is putting dealers in a difficult position. They must either find ways to offset the revenue loss or risk seeing their profits vanish. But dealerships are not the only ones facing financial trouble. The used car market is also in for a major shakeup, and Stellantis owners could be hit the hardest. The used car market crisis: will resale values plummet? When new cars become dramatically cheaper, used cars lose value instantly. This is a fundamental rule of the automotive market, and Stellantis' price cut threatens to devalue thousands of used vehicles across the country. Consider someone who bought a Ram 1500 in 2024 for $100,000. They likely financed the purchase, expecting the truck's resale value to hold steady over time. However, with Stellantis slashing prices, a brand new version of the same truck might now cost $65,000. Suddenly, that one-year-old used truck is worth significantly less than what the owner still owes on their loan. This could lead to a wave of negative equity problems. Owners who plan to trade in their vehicles may find themselves underwater on their loans, meaning they owe more than their car is worth. This situation traps consumers in their existing loans, making it much harder to upgrade to a newer vehicle or refinance their debt. The impact goes beyond individual buyers. Dealerships and rental companies that rely on reselling used vehicles could also take a major financial hit. Many rental fleets, corporate lease programs, and dealerships count on steady used car demand to maintain their business models. If resale values crash, it could destabilize the entire used vehicle ecosystem. For Stellantis, this move could also discourage future buyers. If customers see that their vehicles lose value too quickly, they may be less likely to buy a Stellantis product again, opting instead for brands with better long-term resale value. This short-term sales boost could result in long-term damage to customer trust and brand loyalty. With such drastic price cuts, Stellantis needs to save money somewhere. But are they cutting costs at the expense of quality? Will Stellantis cut corners on quality? When an automaker drastically lowers prices, one immediate concern arises: are they sacrificing quality to compensate? Manufacturing costs are not falling, so Stellantis must find ways to protect its profit margins. This could mean reducing material quality, removing features, or lowering production standards. One red flag is the use of plastic components in critical areas of Stellantis vehicles. In recent years, Stellantis has faced customer complaints about premature failures in parts like water pumps, thermostat housings, and intake manifolds. If cost-cutting measures lead to an increase in low-quality materials, reliability concerns could push customers toward competing brands. Another risk is limited warranty support. If Stellantis is tightening budgets, they may shorten warranties or make it harder for customers to claim repairs. This would save the company money in the short term, but could lead to a backlash from frustrated customers dealing with unexpected repair bills. Additionally, technology and safety features could take a hit. Automakers often offer base models with fewer features to reduce costs. Stellantis may begin stripping down certain vehicles, removing advanced driver assistance systems, high-end infotainment features, or premium interior materials. This could make Stellantis vehicles less competitive, even with the lower price tags. If Stellantis does not maintain reliability and customer confidence, the price cuts could backfire spectacularly. Lower prices might attract more buyers initially, but if quality suffers, Stellantis could end up with an even worse reputation and a long-term sales decline. But while automakers scramble to adjust their pricing strategies, another group is already feeling the heat: traditional dealerships. Could this be the final nail in the coffin for the dealership model as we know it? The dealership struggle: who takes the biggest hit? The traditional dealership model has always thrived on markups, financing deals, and manufacturer incentives. However, Stellantis' decision to drastically cut prices poses a direct threat to how dealerships operate. With lower manufacturers' suggested retail prices, dealerships will have less room to negotiate prices and maximize profits. The question now is, can they survive this shift? Historically, dealerships have depended on the ability to mark up vehicles beyond their manufacturer's suggested retail price, particularly for high-demand models. In recent years, excessive dealer markups have drawn backlash from consumers, particularly during the supply chain shortages of the past few years when prices skyrocketed. Now, with Stellantis offering such deep price cuts, dealerships may struggle to justify their existing pricing tactics. This shift could also accelerate the move toward direct-to-consumer sales models, something Tesla has already pioneered. Tesla has proven that automakers can bypass the dealership system entirely, selling vehicles online and delivering them directly to consumers. If Stellantis' price cuts put too much financial strain on traditional dealerships, the company may explore a direct-to-consumer approach, allowing buyers to customize and purchase vehicles online without dealer involvement. If more automakers begin exploring this model, dealerships may have to adapt by focusing more on service, financing, and aftermarket sales rather than relying on new car markups. Some dealerships may attempt to add hidden fees or push aggressive financing terms to maintain their revenue streams, but consumers are becoming increasingly aware of these tactics. The shift toward transparent pricing, online car buying, and factory direct sales could render the traditional dealership model obsolete in the long run, but the biggest question remains: will these price cuts last, or is this just a temporary correction before the industry returns to business as usual? The future of car affordability. Is this a temporary fix? Stellantis' bold pricing strategy raises an important question. Is this a permanent shift toward more affordable vehicles, or is it simply a short-term tactic to boost sales? History suggests that deep price cuts often come with consequences, and automakers typically do not sustain lower prices indefinitely. One possible outcome is that Stellantis' price cuts could be a temporary measure designed to clear out excess inventory and regain lost market share. If the strategy works and sales rebound, the company may gradually increase prices again over the next few years. Consumers who expect permanent affordability may find themselves disappointed if prices start creeping back up once Stellantis stabilizes its sales numbers. Another factor to consider is whether other automakers will feel pressured to match Stellantis' strategy. If Ford, General Motors, Toyota, and other competitors choose not to engage in a price war, Stellantis could be left in a precarious position, sacrificing profit margins without gaining enough sales to justify the move. On the other hand, if other manufacturers follow suit, we could see a long-term industry-wide shift toward more accessible pricing. Economic conditions will also play a role in determining whether these lower prices can be sustained. Interest rates, supply chain costs, and consumer demand will all impact Stellantis' ability to maintain lower prices over time. If inflation rises or supply chain disruptions return, automakers may be forced to increase prices again, reversing the affordability gains consumers are seeing today. Ultimately, the success of this strategy will depend on how well Stellantis balances affordability with profitability. If the company can prove that lower prices lead to sustainable growth, it could force a long-term reset in how cars are priced across the industry. However, if the move backfires, Stellantis may find itself in financial trouble, struggling to recover from deep discounts that eroded its bottom line. Stellantis has taken a massive gamble by slashing prices by 35%. This move has sent shockwaves through the industry, forcing competitors to reconsider their pricing strategies, putting pressure on dealerships, and raising concerns concerns about the future of the used car market. The big question now is whether Stellantis can sustain these price cuts, or if they will be forced to reverse course in the coming years. If other automakers follow their lead, we could see a long-term shift toward more affordable vehicles, reshaping the industry for years to come. But if the strategy fails, Stellantis could be in for a financial crisis that could set them back even further. What do you think? Will Stellantis' price cuts force the entire industry to lower prices, or is this just a temporary stunt? Let us know your thoughts in the comments.